Okay, some guys coming in. Welcome, great to have you. Yeah, so the SPX S&P 500 E-mini futures. Well, we spoke about it all the way up. I've maintained my short bias all the way up. It hasn't particularly changed. That's still the way it is. You'll remember much earlier I said, look, it can go higher and higher, and it can keep going higher longer than you'd like it. And that's exactly what's happening. I mean, you look short 4900. And I said, look, space out your shorts massively because you want to cast the net wide. Otherwise, you'll bunch up and you'll get an extreme drawdown. Okay, so you should really be looking for like 200 points differentiated entries. 4.9, 5.1, 5.3, and they should be minuscule. They should be much, much, much smaller than your normal size, if that's what you're going to trade. Now, of course, it's fine not to trade the SPX, the Dow, etc. But all that's pushing it up is the continued risk on environment. So investors are willing to take risk because they think that we're at the end of the tunnel for all these economic issues. Now, with the latest inflation data, it doesn't particularly reflect that, but nonetheless, nobody cares. They're buying and buying and buying and buying and buying. Now, you had the same thing here, didn't you? Remember the confidence you had after COVID is sort of settled, if you like, and the worries have gone. You got this rally from 3260 to 480. Okay, 1,500 points, whack, straight up. Morning, Rita, great to have you. Another Academy member in the audience is great. I know you'll be with us at New York for the live on chart session. But anyhow, like I was saying, this was a risk-on environment as well because investors dived in to buy. Now, what happens at the end of the risk-on environment? Well, people suddenly realize things weren't as good as they were, and you get this big liquidation of orders, and it's ferocious, and it brings you all the way down there, and it is a retracement of 50% on the previous move all the way from here. Now, the rise and the risk on was so vicious because the fall was so great from COVID, okay? It literally took you from 3.4 down to 2.2, okay? So a significant drop in the price. But nonetheless, like I said, then investors get confident. So you've got basically the same thing here. You had your fall there and you had your second fall here. It wasn't a very big one, but nonetheless, the confidence is there for investors because they're feeling like they did down here. They're euphoric. They think, wow, it's the age of AI. And it may well be. But nonetheless, there's going to be a point where everyone says that's enough. They sell their holdings and the market falls and falls and falls. And normally that happens after you get lots of good data and lots of good comments. It's just how the markets work. It was the same here and it falls. Now, your job as a trader is to survive all of this, okay? So number one, if you're using stop losses in a risk-on environment, it's going to be much harder because not only do you not have any resistance levels to go off to the left, you've got to fight extreme price action and extreme greed to the upside. We are in an extreme greed scenario. That's why things like this are happening, okay? So if you're going to short your stops, that's why we don't use stop losses in a way, because we can trade really light and cast our net really wide. But if you're using stops, you're going to find that if your risk is the same, you'll start losing money because the risk of the market has changed, but your size hasn't. Your risk as a trader is correlated to your size of entry. It's the only thing that determines how much you lose. So obviously, if the risk in the market changes, your size needs to change. So if you're someone using a stop loss, you can't be trading at the same size that you would have traded way back down here, because you can see the market is much more staged at these points. There's a lot more indecision. It takes longer to move. There's less risk in the market, therefore. But now there's mass risk in the market because look at the pullback difference. There's basically, there's very minimal pullbacks. You could have still hedged on all of this if you needed to, because there are some moves down for 14th December through till Jan, for example, a few weeks with the holidays. So this is all about adjusting risk. It's about changing your size. It's about spreading positions. If you're using a stop, that's up to you, but you're going to have mega small sizes. Okay, if you're not using a stop like we do and hedging for gains as well, you would just take a small size. But nonetheless, you do not want to bunch this up. You want to spread those entries out far and wide. The closer you put your entries in a risk-on environment, the faster and faster the rate of drawdown you accumulate as a trader on your portfolio as a whole or individually on this asset is going to rise faster than you can deal with the loss, and therefore you'll lose money. That is why people lose money trading. Now, I put an email out today and a message. If you're trying to trade and you're thinking tomorrow you're going to be a millionaire, it's not going to happen. It's not going to happen probably after 3, 4, 5 months, 6 months. Okay, for some people they're really quick. Some people are much slower, but most people need years, okay, to get things right. But if you're not willing to do that, you're kidding yourself. You're going to lose all your money. You're going to, okay, because you'll try and trade this with absolutely no risk plans like a headless chicken, and it will go up and up and destroy you, okay? As a new trader, often people have no concept of the mathematical variance of any market, how far it can swing, and the drawdown factor, the risk management factors, everything you need to control to ensure that you're not going to be cremated and smashed out the market and lose everything. Okay, you're only going to learn that through experience. It's like playing an instrument. I was describing that yesterday in our New York live room, teaching members. It's like playing an instrument. You start off and you're plucking around at the guitar strings. You've got no idea what you're doing. You can't string a musical sentence together. You don't understand the rhythm. It's difficult. But as you play more, you can slowly pluck the strings in order, and it makes kind of music. I started learning the piano a few months ago. My mum is actually, or my mother, if you like, is actually, it depends where you are in the world, I guess, how you say it, but teaches piano, and she's taught me quite well so far. But at the beginning, I was an idiot, or I wasn't an idiot, I was a beginner. She was saying, wow, what are you doing? And then I learned, and then now I can play it, I can play Mozart. But I practice and practice and practice because I know that's the only way I'm going to succeed. Now, if you practice trading on your own, it could take like 20 years to get it right, if ever. If you have someone guiding you, it cuts it down because they can tell you what to think, basically. So yeah, that's SPX.